Oscar Health and United Healthcare are two healthcare stocks, and investors have become more interested in healthcare stocks in recent months because valuations have become a lot more attractive. So, in this video, I'm going to compare Oscar Health and United Healthcare and answer which one I think is the better buy for long term investors. I'll compare them on several critically important financial metrics, including revenue growth, operating profit margin, and returns on invested capital. I'll also share with you my proprietary discounted cash flow valuations for these companies that calculates a fair value for these stocks, and I'll compare it to the current market price. So we'll see if these stocks look undervalued at current market prices. I'll do all of that in this short video. So let's get right into it after a brief message from my sponsor.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So looking at the revenue growth chart going back to 2019, two things stand out. Number one is the difference in size of these companies. United Health is an absolute giant, generating $386 billion in revenue over the trailing 12 months. However, its growth hasn't been as explosive, increasing at a compounded annual growth rate of 10.5% over the previous decade, which is a really strong growth rate for a company of this size and this risk profile. But it looks extremely small compared to Oscar, which has grown its revenue by 76% compounded annual growth rate over the previous few years, 6 years or so, growing from 500 million in revenue in 2019 up to 10.7 billion in revenue over the trailing 12-month period. Next metric I wanted to compare these companies on is the operating profit margin. And Oscar Health has done a great job in improvements in this category, but trails behind the operating profit margin of United Health. So Oscar Health generated an operating margin of negative 1.2% in the previous 12-month period. That's up from negative 54.5% in 2019. Oscar Health Management has said that it expects the operating margins and the overall business to operate under normal conditions again in 2026. So it expects a return to normalcy. It expects improving margins in 2026. United Health has said similar things. It said that this year they underestimated their cost by over $6.5 billion, and that's hurting their margins. And because of their inflexibility of their pricing policy, they have to wait until 2026 to make improvements. So they both expect improvements starting in 2026. United Health's margins have fallen to 7.3%, down from 8.1% in 2019. Their margins will likely be lower again this year and next year before returning to larger levels starting in 2027. Next metric I wanted to compare these two on is the return on invested capital. Again, similar trends with United Health having the better margins, more stability at 10.4% compared to negative 7.1% for Oscar Health. But Oscar Health has improved from negative 69% all the way up to negative 7%. It was positive at 3.3% in 2024 before the difficulties it faced this year brought the margins, brought the ROIC levels back down to negative 7.1%. They each have demonstrated, or they have each explained to investors that they expect things to improve next year. And it's reasonable to assume that they will improve, given that the primary reasons why their businesses have suffered is an unanticipated increase in utilization of hospital visits and doctor visits from patients. United Health and Oscar Health weren't expecting people to be going to the doctors and needing as much healthcare assistance as they have in 2025. United Health Management, especially, made huge miscalculations on that front, and that's what led to that underestimation of $6.5 billion in costs. They've both said that they're going to adjust their models and update their pricing policies going into next year, so that should improve the company's profitabilities going forward. So now that we looked at some critically important financial metrics, let's look at valuation. So United Health Group, I have the intrinsic value per share calculated at $429. The current market price is $320. And so this stock looks undervalued. And I've been saying that for the past several months that the stock looks undervalued, and I've had UnitedHealth stock rated as a buy for several months now, ever since the big stock price drop that initially brought the stock price low. I made a similar calculation for Oscar Health in the intrinsic value per share at $36 compared to the current market price of $20. So this stock also looks undervalued, and I've had Oscar Health stock rated as a buy also. So I've had each of these two healthcare stocks rated as a buy. The healthcare industry in recent months has been attractive when measuring by valuations and the lower risk profile given their lower correlation to macroeconomic growth. If I had to pick only one of these stocks, which one would I choose? Oscar Health or United Health Group? It would be close. It would be a tough decision. Oscar Health is generating much better growth, but also more volatility and a higher risk profile. United Health Group, lower growth, but also more stability and lower risk profile. If I had to pick one and you forced me, I would pick United Health Group as the better buy compared to Oscar Health. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.